right, guys, welcome back to the Relai Bitcoin podcast. Today we have an absolute OG legend with us, Adam Back. Thank you very much for taking the time.
Yeah, thanks for having me on.
You are one of the people I know that are very, very, very deep, like one of the deepest in kind of the tech and also in terms of the cypherpunk movement in this whole, not even Bitcoin, but also like money on the internet field, right? Because you started much earlier to think about an internet native money, a sound money that is not controllable and independent from governments and banks and central banks, etc. But now, of course, since Bitcoin exists, you're also heavily involved also with Blockstream, your company, and you, as I see in the back, you are thinking about how could we also scale Bitcoin on the base chain and make it more efficient there. But you're also working with Blockstream on Liquid, Lightning, and other second, third, whatever layer solutions. So you're one of the most interesting people to talk about Bitcoin scaling. How do you see Bitcoin scale, and how can we onboard as many people as possible on the base chain, ideally, or on other chains? How do you see the future there in terms of Bitcoin scaling?
Yeah, I mean, I think the fundamental issue is that blockchains are hard to scale. So
Yeah.
there's no silver bullet, and then it depends on, and I think experience has shown us with Bitcoin and with technology adoption in general that the best you can do is incrementally improve things and see what the market adopts. And the market could be users, it could be startups that find something interesting or find a use for something that you didn't anticipate, and then you adapt, right? Because I think, because Bitcoin is so decentralized, unlike a startup, I mean, a company like Microsoft or something, they can control their platform, but even for them, they could put out a new API, and if no developers use it, it's kind of irrelevant, right? So,
Yeah.
and so you see some things like that having evolved in terms of sort of de facto Bitcoin scalability or sort of improvement for Lightning, which were organic and not anticipated, which is the Bolts exchange protocol, which is it started as a submarine, a trustless swap of a Bitcoin UTXO to add or remove capacity from a Lightning channel in a trustless way. And in a fee surge many months ago now, it created a problem for their service. Fees got too expensive, swaps got stuck, and so they took some time over a few weeks. I think they might even have paused the service while they try to find a workaround. They implemented a similar kind of swap, submarine swap from Liquid Bitcoin, but still the Lightning channel is a main chain channel. So if you have an existing channel, what they found is, Lightning within its existing channels, routability works fine, but rebalancing was expensive. It was the on-chain transactions. So by rebalancing on different layer two, Liquid Bitcoin, they could more cheaply and quickly rebalance existing main chain channels. And so that was a kind of reactive thing that people didn't see coming, and then it got adopted by other people. So it was popular with users. Even after the fees went down, they kept using it because it was cheaper and faster. And some of the people who use that kind of thing are like power users or startups that manage channels. So they found it useful and they used it. And then it led to something new, which nobody saw coming, which is a new type of Lightning wallet, which is actually a liquid wallet and uses the Bolt's submarine swap to send Lightning by spending Liquid Bitcoin to the API, and then the receiver would get paid in Lightning by Bolts, or the other direction. That to receive Bitcoin, they would ask the sender to send Lightning Bitcoin to the Bolts API, and then your wallet would receive the Liquid Bitcoin. And so it originated a new type of wallet, and there are two or three of those now. One is Aqua, I think another one is Peach, and I think there's another one or two. I think Bull Bitcoin has one too. So there may be about 4 wallets live or in development do that. And it's a different model to Greenlight, which is, has the keys and is participating in Lightning using a kind of server assistance model. With Bolts, the wallet actually doesn't have any Lightning capacity at all. It's swapping real time for liquid Bitcoin. It's a different trade-off.
Yeah, that's exactly the interesting question, right? How far can we go with like scaling self-custodial Bitcoin? Because it's already rather easy to scale for retail investors or like random people that on the street that want to use Bitcoin for a couple of $100 or even for a 10, 20, $30. They can already do this in custodial ways. That's kind of scalable on that side. It's of course not decentralized and not self-custodial, but it's cheap and scalable with the transactions. And then also Lightning in a rather non-custodial way. With Lightning it's possible. But then if we really see these high fee environments, soon it will maybe for small users not be possible to use on-chain at all, or maybe at a later stage it will be also hard for them to swap into Lightning. That's what we have experienced, for example, now that we have also a Lightning wallet integrated in Relai, to swap from the Relai on-chain wallet to the Relai Lightning wallet in the high fee environment was sometimes too expensive for small amounts. It would maybe make sense from $100 upwards, but not less than $100 because it would already cost like $5 or $10 to make the swap, right? So if that becomes the default, these high on-chain fees, how far can we go scaling in a self-custodial manner, or will we need to in the future, accept that most of the Bitcoin transactions will be made through banks, crypto exchanges, ETFs in some sort of custodial ways?
Yeah, I mean, of course, there are people who are focused on the investment aspects, and so like kind of monetary scalability, i.e. they're happy for ETFs. But I think, that as users and what the cypherpunks were interested in and what ultimately derives, that sort of creates the value that, the investors and speculators are relying on is the ability to transact in a non-custodial way. So I think we really want to keep, trying to incrementally improve that. And with the Relay wallet, you are integrated via Greenlight and Breez, where Breez is providing the LSP and APIs. And so one thing that fits into this model is Breez in the last week or so announced interest and intention to add to their offering Lightning channels on top of Liquid. So channels with liquid Bitcoin capacity instead of main chain Bitcoin capacity. And that's something that core Lightning, the Lightning implementation behind Greenlight has had actually at the low level for probably 5 years now or something, but it's not something that's seen a lot of use. It's a technical capability. And so I think what you're seeing now is people preparing ahead to say, well, with these Bolts APIs, with Greenlight, you can rebalance channels, you can splice in, or you can do the trustless swap with liquid Bitcoin, but still opening the channels and closing the channels is going to cost somebody some money. And so maybe for smaller amounts, it's interesting to offer users the trade-off of having a liquid Bitcoin Lightning channel. And Christian Decker has spoken about this for Greenlight, that potentially he sees it as a straightforward capability that can be improved within Greenlight to interoperate Lightning on top of Liquid with Lightning on top of Bitcoin, so that some of the channels managed by Greenlight, the end user would be using Liquid and some would be using Bitcoin, Lightning on Bitcoin. And so you could have channel routes somehow which are backed by main chain or by the other layer 2 sidechain being Liquid. And of course, there's a different trade-off Liquid is typically more for short-term things, like not so much for cold storage because it's not as Vera doesn't have such a good long-term censorship resistance story, and it's due to its like design and the trade-offs it offers, which is, for traders to do trustless swaps. It supports stable coins, which the main chain doesn't directly. So trustless swaps for traders, things like that. So it gives them a better trade-off than relying on an individual exchange. But it's also proven, a new avenue for payments organically, that people have used it in that way, right? So it's another example of the market using something for what it wants. So, at least Aqua has been trying to get adoption for liquid Bitcoin and using bolts for the Lightning swaps and Tether stablecoins and then other currency stablecoins in Latin America, for example. So you've seen the retail use there. So it's a different trade-off, but I think potentially it's a reasonable trade-off for moderate amounts of, Bitcoin. Such, for example, the amount of Bitcoin that somebody would put in a hot wallet or in, that has less value than the smartphone it's held on, for example, where they could drop the smartphone and break it or something, right? So, so it's a trade-off, but it offers a prospect of another kind of improvement in scalability and fees and speed of setting up channels. And of course, it's sort of, sometimes the things that you would want to see on the main chain end up on the layer two, and things you expected on the layer two end up on the main chain, and you can't do much about it because the people that use the main chain are the people that pay the most. And we might have opinions about what would have been a better use for the main chain space. Some people like JPEGs, some people don't, for example. But the fact is, they're there and they're paying the fees. And so if that pushes, some kind of retail to merchant payment, Lightning channels or direct payments into other layer twos. I mean, another one being the Fedimint approach, right, which is a similar kind of security trade-off to Liquid in a way. You've got a federation of different operators. That is what it is. That's the market, right? So, you can never get the sort of what individuals or startups or power users think would be better isn't necessarily what happens. But as long as we keep, iterating and improving and adapting to what the market is de facto choosing to use, then I think there's scope to scale. And so I think what you see with that Breez announcement and what Christian Decker has been saying about Lightning on top of Liquid is that could be the next step, where the rebalancing of Greenlight was a step to make it easier to integrate, to reduce the cost of rebalancing. Then Lightning on Liquid Bitcoin is another boost to scalability and improvement in channel opening times and channel costs with a different trade-off.
Hey everyone, this is Joel from Relai, and I'm here today to tell you about Relai Private. It's our exclusive service for private clients, small offices, small to mid-sized businesses, or just anyone looking to stack more sats with a higher volume. As a Relai Private client, you'll have access to a dedicated account manager, a team, and obviously a white glove service to help you with your Bitcoin needs. You also get personalized 24/7 access to our team, and you are in it for the special selection of reports and data we are sending to our Relai Private clients. If that sounds like something you or someone you know should like, send them to relay.app/private or click the link in the description below.
Absolutely. Then, as you describe it, I see Liquid like as a bridge between on-chain, which is like seen as the digital gold by the broad masses, and like whenever they have a certain amount of Bitcoin that they want to hold long term in cold storage, they put it on chain. But for things like stacking, for example, like if you have a $50 weekly stacking sats plan, auto invest savings plan, whatever, then you would amass all these small UTXOs, which will be almost unusable when the fees get high on chain. So you are looking for something else, which could be liquid, with the option of holding and transferring it very cheaply, but also at any time being able to quote unquote withdraw it to on chain whenever the amount is high enough and reasonable. And also it's a bridge towards then the not digital gold, but more payments system like Lightning, right, where you can globally almost for free, almost instantly send very small amounts of Bitcoin, and then this bridge or this swapping in and out through liquid would be much more efficient and much cheaper and much faster than to always opening and closing channels or swapping between on-chain and Lightning directly, which is very expensive. It's even more expensive than one on-chain transaction, right? Is that how we could summarize it?
Yeah, I mean, I've seen a few people describing this use case, doing how-tos on it. BTC Sessions, who makes lots of nice demos of different wallets and power user use cases, has made a few videos showing that concept about, doing sort of weekly buys on Lightning, moving that to liquid when it gets to a certain level. When that reaches, I think his example is 0.01 Bitcoin minimum or something, then putting it into cold storage. Mm-hmm. And I think that's actually good advice for users as well, because as you said, there is a risk that, somebody who's not very expert in how Bitcoin works, they may not realize that how the UTXOs are happening. But if you put two small UTXOs onto the main chain, that might work now, but in the future you could get in an awkward situation where it becomes too expensive to spend, where the fees too big a percentage of the UTXO, and that'll be disappointing. So, suggesting to avoid that is probably helping them. I think Francis Pouliot has been talking about that also. So I think that's an interesting strategy. I think Aqua may even provide a kind of tip to say that, when it's time to move it between the wallets, they label it in a different way, sort of saving versus spending or something in their wallet, right? Because it also has main chain support in Aqua. Sideswap is another one. That one is liquid only, but it can send and receive Bitcoin via peg in and peg out services, whereas Aqua is liquid and main chain and Lightning via bolts. So there are different models, and of course, your Relai wallet is main chain plus the Breez and Greenlight APIs, which is interesting. And you had some very good statistics actually about adoption, right? In a short period of time, actually reached, I think, significantly from Breez. From Relai, we reached a point where there were 100,000 hosted Lightning nodes, and the hosting is, for the viewers, is a kind of server assisted, but the keys remain in the wallet with Greenlight. So it's a kind of nice trade-off where you get, this sort of performance and lower footprint wallet characteristics from having server assistance, but you still have the keys, so it's still, very clearly non-custodial. So it's just a different trade-off for a Lightning model with some advantages.
Exactly. That's exactly the goal, to get the performance or the efficiency of holding and trading and sending and receiving Bitcoin on any chain, but always holding on to the private key and being self-custodial, because I think that in the future, that will be the future, how we can really provide the best user experience despite the regulatory clampdown that is coming, because regulation, especially MiCA here in Europe, but overall in the world, will be very harsh on custodial players and much less on self-custodial players. So I believe in the future we will be, as if we can adhere to this self-custodial model, we'll be much cheaper, much faster, much more user-friendly. And therefore the adoption of Bitcoin will move more and more towards that direction. But then the key is really to keep this self-custodial model, where I'm not sure if this, like as we are doing it now with main chain and Lightning, both wallets basically have the same private key as a root. So that, and this is only held by the user, so that works. Now, if you put Liquid in the mix, can you help us understand like where on the spectrum between non-custodial and custodial this is? Because it's kind of a hybrid, right?
Right.
Would this maybe compliance-wise, like legally, would it still count as non-custodial because there's a private key behind?
Yeah, so I think, some of the wallets use the same seed for Bitcoin and Liquid. So I think Aqua and Pool Bitcoin do this because it's complicated to have multiple seeds to back up. Green has switched to that model, as of a few versions ago, but it's sort of a more power user wallet, so you can choose to have, different wallets with different seeds if you want, like a Liquid one, a Bitcoin one, or vice versa. But the default for new wallets created in Green is also a shared seed between main chain and Liquid, and actually Lightning also, because the Green wallet has experimental support for Greenlight as well, Lightning by Greenlight. And in terms of the trade-off, it's I think there are, of course, lots of altcoins with block signers and validators and things like this that are operating in a similar way. So I think there's a sort of precedent. Now, of course, Liquid is more like a Bitcoin layer 2 or sidechain, so there's no altcoin. It's just pegged to Bitcoin. But still, it's it's federated, so there's no mining, just block signing. And there are hardware security modules which are operated by different participants, Liquid participants around the world. So, exchanges and market makers and wallet providers in different companies who have anyway this sort of business need to run servers typically. And so it's, it presents that trade-off where I think it's much safer from, a number of factors than relying on a single party. So if you put a balance on an exchange or in a custodial wallet, if there's a hack or if the operators, go rogue like FTX or something, then you're exposed to that single party, right? And that unfortunately has happened every year or two, that something, turns out to be fractional, or they borrowed the money in the case of FTX, or things like that. They got hacked. So with Liquid, that kind of risk is much lower because one entity can't move the funds, and they're running an unattended piece of hardware actually, so they don't really have a way to override it. They'd have to compromise the hardware, and a big threshold of them would actually have to collude and compromise the hardware. So that presents a much lower risk of malicious behavior. It's protected by the hardware security modules, so it's not like the Liquid balance is not hot. So then that's one trade-off of Lightning, that technically all of the Lightning capacity is on various hot wallets, effectively, right? All the nodes are holding different balances, whether they're routing nodes operated by LSPs or users while they're online. It's all hot, right? And Liquid aims to be cold, and how it achieves being cold, even though these block signers are signing it and managing the peg, is the hardware security modules will only allow peg outs to cold wallets that are operated by the peg operators. So that means, to do a peg out, you go via one of the APIs or service provider's business offering, right? Where, sometimes they will swap from their hot wallet for pegged out coins. But the peg out coins technically can't go directly to the user. It has to go to a cold wallet of one of the Liquid members. So that's how we ensure that the Liquid peg is cold. And yeah, so obviously different parties that are using Liquid are licensed for different things, like their exchanges or their custodians or so on, or they operate in different countries with licenses or approval from regulators for different things. So I can't talk about their individual kind of regulatory opinions or legal opinions, but yeah, there is like quite a bit of precedent and de facto kind of blockchain treatment of liquids, which is clearly not the case for single custody, because then you're a user, you have signed up some kind of agreement, they're a custodian with an exchange or with a custodial wallet. It's kind of a gray area, I suppose, but it seems that single party custodial wallets are generally being phased out in favor of non-custodial.
Got it. So do you see a future where, so we mentioned pretty much four, and there are more, of course, but four protocols, the main Bitcoin main chain, then Liquid, Lightning, and also you mentioned Fedi, which is also a protocol probably on the same layer, quote unquote, or comparable to Liquid, where there's also federations, but there they can be various different, that they don't have to be regulated entities or like server running exchanges, etc. It can be all sorts of companies or individuals. That's how I see the difference, but it's similar, like a federation, a consortium kind of collaborative custody solution. So do you see a future where these four will like absolutely will be interoperable, and then for the user, let's say in 5 years from now, the user will have just the Relai wallet or any other, a Green wallet or any other wallet. The retail user who doesn't care about like whether it's on Lightning or Liquid or whatever, he just sees Bitcoin, right? And then depending on the use case, like, okay, I have one Bitcoin on my wallet. If I want to put half of the Bitcoin to an external wallet, I will maybe it's on Liquid, but then I will make an on-chain transaction. Or whether if I want to buy a coffee for $3, then even though it's on Liquid, it will just send it through the Lightning network. Or if I want to send, someone who shows me a Lightning address, like QR code, it will just swap it behind. I have some Bitcoin on Liquid, maybe, and it will swap it to Lightning. Or if I have some Bitcoin on Lightning on my Relai wallet, and someone shows me a receiving address from like that is maybe on Liquid or on chain, it will just swap it and send it there, and all kind of interoperable, always depending on the use case, choosing, and that would be the application layer that does that, choosing which protocol is the best to use, and making these swaps maybe through this bridge of Liquid that we have discussed before.
Yeah, I mean, I think another kind of organic thing that has happened in terms of how people are using the different layers is that Lightning seems to be being used as a bridge between them. Now, that may not be what people expected. Like maybe they would have thought it would go through the main chain and put it in and out. But it turns out Lightning is quite convenient for moving money from. Of course, you can get money in and out of Lightning using the main chain. But once it's in Lightning, you can move it to Liquid very quickly and cheaply through the Bolts API, for example, and you can move it to Fedimint because they have Lightning sort of pay in and out kind of APIs. So it seems that Lightning has evolved to be the default like connector between different Bitcoin layer 2s, which is cool. And then the other thing that you were saying is about, could that get more automated and seamless over time? And I think that's probably where it's going. So at the moment, originally it was a bit manual, right? So BTC Sessions had his video showing, the user should go to the Boltz API and cut and paste the addresses and rebalance. But now you have like Aqua and Bull Bitcoin they hid that API behind a wallet. So it got a little bit simpler, but it's ultimately doing the same thing. And I think there's some discussion about making kind of unified QR codes that could
Yeah,
receive either network. So that's another way to kind of automate that.
exactly.
So I could see that converging over time. And of course, some people are using the Fedimint proposals, which are maybe a bit newer. I'm not sure if there are, wallets with the Fedimint and Bitcoin and Lightning and Liquid, but there are starting to be a couple of Bitcoin super apps that include more layer twos in one wallet. Like Green has 3, but I think there are some that have 4 or 5. So that's an interesting development. And so, you could see the user interface evolving to make that simpler. Sort of doing more automated conversions, making the interop work, and making a kind of super QR code that can handle anything or something, right? And then I don't need to know. Like somebody shows me a QR code and my wallet can send to it either by conversion or by a balance already have or something.
Exactly. It will just look for the most efficient way to do
But I think the
the
impediment for the moment is that, because a main chain transaction is expensive, then people don't thank you for automation when it gets expensive, right? They want to be warned if it's going to do an expensive action. But if the action is cheap, reasonably cheap, and just reacts to how the recipient wants to be paid, then people don't really care how it happened, right? But they do want heads up if it's going to be expensive or slow, because then they're exchanging messages with the recipient about why they didn't get paid, or they're upset about it cost more than they expected, and if they'd have known, they would have done it a different way or something. So yeah, I think that's like one factor people are wrestling with now with wallet user interfaces. But it is slowly getting hidden behind higher level concepts in a wallet, which is an interesting development.
Absolutely. In the end, I think where we need to get to is that a user doesn't have to know what is behind all this from a technical point of view. They don't need to understand this whole heavy lifting in the back end. They just see I have Bitcoin in whatever form it may be, but I have Bitcoin, it's rooted to my seed, and maybe in between it can swap between on-chain, Liquid, Lightning, Fedi, whatever. And they want 3 things. In the end, they want it fast, cheap, and simple. Right, fast, cheap, and easy. And if we can get there, I think that's really the key to global mass adoption of Bitcoin. Because then, why would you use a clunky TradFi user interface like a bank or even a neobank will look very unuser friendly if you can just have global money that is interoperable and instant, fast, cheap to transact with, and there's one basically QR code or whatever. So you don't need Venmo or Square Cash in the US, and then, for example, Twint in Switzerland. I don't know what they use in Malta. I don't know what they use. There are all these different payment apps. Right?
Yeah, Revolut is quite popular, or some of the other kind of similar things. And I mean, some people have argued that, Bitcoin is for saving credit cards and debit cards for a better experience, but I disagree just based on personal experience anyway. Like I have, a card that I use to book flights or hotels, and I don't use it very much in between. And every time I use it, it gets blocked. And then I have to spend, half an hour on the phone while I'm trying to travel, maybe paying roaming fees, just getting to unblock my card. And this is not convenient. This is extremely inconvenient. I just want them to, make the payment. And I suppose the reason they are triggering all these fraud alerts is because their payment system is completely insecure, right? Whereas Bitcoin is, if you've got your private keys, it's unhackable. So you can have extreme confidence in finality of the payment, and you don't need all this fraud management, and that's all creates costs too, right? Like all of the fraud they're managing, or the fraud management, that's why the credit and debit card management fees from the payment processors are like multiple percentage points to the merchant. So it's like incredibly inefficient. Plus, it's supporting a whole criminal kind of enterprise of card fraud, right? Which is growing linearly. So they never really solved it. And I think, you know, if they had, I mean, of course they evolved, right? They went from a mag stripes to the chip and pin, but still they seem to have problems. So I guess when you make an online payment, you're not using a chip and pin, right? So then they're back to the fraud issue. So really, Bitcoin seems to me to be a lot more convenient. You get the QR code and you pay, and it works. That's it.
Yeah, exactly. If we get it right, I think that's it. But then also, as we've seen with the main chain, I mean, when you started with Bitcoin, probably 14 years ago or something, then it was still easy. You know, one sat per byte transactions. You know, it was super easy to hold and transact in a self-custodial way on chain. Now it's not anymore. Now you have sometimes, if you're lucky, 10 to 20 sat per byte, sometimes over 1,000 sat per byte when it gets really crazy. So then it's unusable for these data transactions. So okay, this is moving loads to second and third layers like Liquid and Lightning, etc. But also there, like, are they infinitely scalable, or will the same happen once there's a critical mass, for example, on Liquid, that the fees will also increase there, and then it's not going to be user-friendly on a day-to-day basis? And what happens next? Will we need other layers, or how will this whole system scale?
Right. I mean, yeah, I wasn't actually active in Bitcoin until 2013, but it was like you say, you know, for some years or still then, yeah, I mean, Bitcoin main chain transactions were low cost and the blocks weren't full. So it was fine to do, you know, on-chain transactions for small amounts, but because it's more popular now, so it's difficult. And I think, you know, the other thing you said there about will the next, you know, the current spare capacity in like Liquid eventually get overpopulated and have the same scaling challenge. So I think that yes, I mean, blockchains are hard to scale and Liquid is a blockchain, and so, but I think it has some. I think there's a reason that you can make a different trade-off there. So the problem with pushing scale into the main chain is that it pushes up the verification cost, which, you know, there's not, you know, which people don't want, right? They want the sort of validation assurance that the cost to synchronize and verify for themselves the transaction is reasonably low, so lots of people can do it in principle. You know, not everybody has to do it, but the possibility to do it needs to exist. And so I think one trade-off you can make on Liquid is it's easier to get consensus to, you know, increase its parameters, let's say, because, you know, it's an opt-in layer 2. If you don't like those trade-offs, you could go back to the main chain or use a different layer 2. So that's a bit easier. And then I think the verification cost could reasonably be higher. So, you know, maybe you need a faster internet connection and a faster computer, like the minimum hardware and network requirements to verify Liquid could be more like desktop and power user, let's say, right? Now, of course, you don't want it to be, well, only, you know, an expensive machine in a data center with enough bandwidth could verify it, because then it's not really a blockchain anymore, I would say. But, you know, there is some wiggle room in between that where you could move towards the more power user bandwidth and verification costs. So somebody with a, you know, a high-speed internet connection, a desktop computer, can verify, like catch up with history and verify it. Now, you know, Liquid is a lot cheaper than that now, so that shows that you could, you know, push it a bit further. I think the other thing that makes Liquid a different trade-off is the confidential transactions. So they, you know, they use bandwidth, they use storage, because those range proofs are bigger. You know, the transactions are about 10 times bigger than Bitcoin transactions. And they also are more expensive to verify. So the full node has to verify those range proofs, which are, you know, equivalent to dozens of signatures. So the transactions are a bit heavier in verification costs for the CPU and in storage cost and bandwidth cost to fetch. But at the moment, you know, at capacity, I would assume that because the liquid blocks are 1 minute instead of 10-minute average in Bitcoin, and they're the same size limit, like they're, 1 megabyte plus, and then the 4 megabyte weight, it could be up to 10 times as much data per day, year, etc., right? And more computation to verify. But I think as long as it's sort of sensible, like not too much to verify, you can do that. And then there are some technologies. So we worked with a group called ZeroSync, which is doing some interesting things on Bitcoin actually, but they could be applied to Liquid too, which is to make a zero knowledge proof for the verification history of Bitcoin. And, so we partnered with them to broadcast that information on the Blockstream satellite. But it's an interesting bit of technology because it's using these new zero knowledge proof systems so that you could sync a node more quickly by downloading a UTXO snapshot. So, a node that's already synced, look at the UTXOs that are not spent, and then locally so you could download that, and then they would make a proof that all of the transactions before that were verified and valid with a zero knowledge proof, and then you get that zero knowledge proof, and maybe the zero knowledge proof is a megabyte or so and takes some verification, but now you've got a lot less bandwidth. So it's not the same thing because then you don't have the history, so you can't actually look at the history, but you have a proof that the history was valid. So it may not be a trade-off that people are going to want on Bitcoin because the ultimate verification is, well, I want to be able to get the history and look at it and verify it in a more simple way. But for a layer 2 that's opt-in, it could conceivably use something like that to have, a faster and lower bandwidth way for people to verify the history. So that would be another way to go a bit. And there are optimization opportunities, the confidential transactions, we have some libraries to make them more compact that we haven't deployed yet. So there are things that can be optimized. So that there's some headroom there. But eventually, you get to a point where, blockchains don't scale ultimately, right? So we're still in the area where there's no silver bullet. But the zero knowledge proofs are a very active research area, and so maybe there's scope for those themselves to become more scalable or be looked at with a different model where people would have more confidence to switch the model. I think other systems that have used those zero knowledge proofs of history have what they call a data availability service. So if you want the history, you can go fetch it, which is the equivalent of the Bitcoin full node sync. You get all the history, right? So I think in Bitcoin, people would not necessarily be happy about a two-tier system where you can get the history, but it's more centralized, and so fewer people can do it, and it's more expensive. But on a layer 2, maybe that trade-off could work, or maybe some new models arise, some new layer 2s and new models. So I think we've got headroom for now to improve what we currently understand, and then we just keep going.
Yeah, absolutely. I mean, it's certainly promising if you look back the last 10 years, what happened, because 10 years ago, no zero knowledge proofs, no second layers, right, third layers, whatever, nothing was there. And if you look at what happened in these 10 years, what can happen in the next 10 years, right? It's very promising.
Yeah, I mean, it's interesting. I mean, these zero knowledge proofs are kind of like a signature of execution or something, which is a very counterintuitive concept, but that literally didn't exist when Bitcoin was launched. It's a new thing, and it has some quite interesting, computer science, computer architecture implications, which are still being understood, and the cryptography is still being improved. So, some of them are a bit experimental. And of course, Bitcoin itself likes to use only, very secure and conservative choices for everything. But some of those crypto systems are using the same security assumptions as Bitcoin. So, for example, the bulletproof ones, which people will have heard of, are using the same cryptography as Schnorr signatures, really. So I think, if you trust Schnorr signatures, you should trust those. Ideally, there's a bit more complexity, but that's the core security assumption under it. Whereas others are using more experimental cryptography, like the cryptography used by the zero cash paper, and there are a few altcoins that use that related tech. That's more experimental. And like some of them actually had problems, There was a bug in the paper and it got implemented and they found out live. So it shows it's not a joke to use things which are too experimental.
No, of course, absolutely. But that's how the internet scaled in the end as well, right? With these there was a lot of experimentation, a lot of different proposals, a lot of different protocols, and then the protocols that really worked for a certain use case, they would stack, and now we have like 7 layers, and that's how we went from barely being able to send an email within 10 minutes to now streaming whole movies or even live streaming a box fight over Netflix globally, etc.
Yeah.
Right? And that's what's happening now as well. It's very interesting to see.
Yeah. I mean, I think the key thing is you want to, keep the bearer nature and keep it permissionless, because permissionless networks are able to innovate. Think regulated networks like GSM or the telephone companies pre-internet. You couldn't make a startup to do a VoIP app or something. They wouldn't let you. It wasn't even regulated, so probably the regulators wouldn't allow it, and you'd need kind of like permission from a government-owned telephone monopoly or something. So it just wasn't happening, and there was no innovation. And then the internet unlocked that. And so, I think in a lot of ways, people say things like, Bitcoin is separating money from the state, and that's true. Also, that's more of a geopolitical comment, but it's also, making Internet of Finance a permissionless network, which is, it's good for innovation, right? We get many more kind of trustless and long tail use cases and innovation and opportunities for startups to participate and do interesting things. It's much harder to innovate in TradFi, and of course we can rely on, people can use PayPal and things like that these days, but that itself was a form of previous generation innovation, because before that you'd need a merchant processing account, which is pretty hard to get.
Yeah.
But now we have Bitcoin, so you can just embed some APIs in an app, like you guys have done with the Breez and Greenlight, and now you have an app, and of course you were already in the kind of onboarding users service with connections to like payment mechanisms, but it's also possible for people with a game or something with some form of payment in it to integrate an API like that and quite simply have an application that is moving small amounts of money between users in relation to the game or something, which would be much harder without that.
Exactly. That's super interesting. Thank you so much for taking that. I don't want to take more of your time, but I'm really grateful for all these explanations, and we will talk more in Prague. You will be at the conference as well, of course. And
Yep.
I still need to, because this is a tradition of this podcast, I need to ask you one last question. So, of your whole wealth, how much of it, in a percentage wise, is in Bitcoin?
Pretty all in typically. Yeah.
Pretty all in. So we had everything from like 1% to 120% because people are on leverage. But
Yeah,
all in,
I
would
haven't
say around 100%.
really like flattened it out and added it up, but It might be over 100 even. It's varying, right? Yeah.
That's the way to go. Cool. Thank you so much, Adam. Talk to you later in Prague.
Yeah, likewise. Thanks. Bye.
Bye.
Hey, this is Joel again from the Relai team. First of all, thanks for listening or watching to the podcast. We really appreciate your help here. If you want to actually help us out further, you can leave us a 5-star review in the Apple Podcasting Store, in Spotify, on YouTube, or wherever you listen to podcasts, because this way we'll actually reach more people with this fantastic content. And I'll see you in the next one.